Beijing's bazooka goes to Berlin and bonds get bombed for it. So Germany announced a major fiscal spending plan, and while details are scant, given the scale of what it seems to be, some are calling it a bazooka. Germany's bond market is certainly taking it that way, with a major sell-off over the last couple of days, which have sent yields to their highest since October 2023, only a few basis points away from their highest since 2011. Oh yeah, and the ECB cut its interest rate again today, yet hardly anyone noticed with the unveiling of the Berlin bazooka. Now there are several moving parts to this, yet what it amounts to is a possibly dramatic shift in the German government's stance. The Germans have been the lone stewards of fiscal responsibility, not just for Europe. Given the country's economic history, even the perception of being profligate was more than frowned upon, let's say. Yet the economic situation has become untenable, and there are other political considerations beside, but that's the unspoken aspect to all this. Finally, the government is tacitly admitting Germany is in a deep depression. But what do they do about it? Naturally, when nothing else works, Keynes says throw tons of borrowed money at it. And everyone these days is a Keynesian, even apparently the Germans now. That's one reason why the knee-jerk reaction in the bond market has been severe, at least here in the short run. And even so, it actually isn't all that unusual. We've seen something similar a number of times before when fiscal dominance is asserted by government authorities, including several examples here in the US. Hardly anyone remembers them because in the long run, they don't do anything. All these stimulus plans do is rack up even more debt with little if nothing to show for them except for that debt. So is this a game changer for the depression in Germany and Europe? Will this unleash inflation? Where do bonds go from here? There's a whole lot to unpack, starting with what actually happened. As Politico reported yesterday, Europe's most powerful economy, well, it used to be the most powerful economy, is poised to take a major step to bolster its defense capabilities, with Germany's Chancellor-in-Waiting Friedrich Merz announcing a far-reaching plan to effectively exempt defense spending from the country's constitutional fiscal restraints. In view of the threats to our freedom and peace on our continent, Merz said Tuesday evening in Berlin, the motto, whatever it takes, must now be applied to the country's defense. Merz proposed that defense spending above 1% of gross domestic product be exempted from the restrictions of Germany's constitutional debt brake, which limits the structural budget deficit to 0.35% of gross domestic product, except in emergencies. The announcement on the debt brake overhauls marks an extraordinary turnaround for Germany's conservatives, who have long advocated for fiscal restraint and who enacted constitutional limits on spending in 2009 during Angela Merkel's reign and amid Europe's debt crisis. The plan comes as Germany's Bundesbank on Tuesday proposed a reform of the debt brake that would lift the cap for the annual net borrowing to 1.4% of GDP from the 0.35% where it is currently. That would create around 220 billion euros in additional spending room, at least by the end of the decade. There's the caveat that they throw in there. The Conservative and SPD leaders also announced a proposed 500 billion euro special fund to finance infrastructure projects outside of normal budgetary spending over the next decade too. A plan designed to stimulate Germany's ailing economy and also to appeal to left-leaning lawmakers who otherwise might oppose loosening debt rules just to enable defense spending alone. And if you remember back in November when Germany's government fell, it fell because of this argument over what to do about the economy, about whether or not Germany could borrow more money to throw the Keynesian stimulus at it to try to get Germany out of its current depression. Let's be honest, they're in a depression. You see some of the statistics around Germany, starting with GDP, but really industrial production. As they keep saying, it's one of the saddest statistics of any country anywhere in the developed world. So the German economy is in a deep hole. The German government, after spending the last couple of years saying there was nothing wrong, how dare you criticize it, finally been forced to realize that and admit the situation there is untenable. That's what voters have done. That's what the election did. It lit a fire under politicians who now feel they have to do something about the economic situation when we see time and time again they have little solution for it. But politicians are going to do what politicians are going to do. They're not going to say we can't do anything about it. They're going to do what other politicians do around the world, which is spend, spend, spend. But the fact that this is happening in Germany is significant because Germany's been the one place more recently that has exercised restraint on fiscal dominance, fiscal spending, fiscal borrowing. So the implication is if the Germans are throwing their hat in with all the rest of the profligate governments around the world, then maybe that unleashes far more beyond what we see from what plans we have of this German bazooka. So the bazooka that we see in Germany, like everywhere else, like China and other places, it's always a response to global economic conditions. And that's something that we're going to be talking about on Monday, March 24th. Time is yet to be determined, but you can still sign up for a webinar that we're holding on Monday, March 24th. There's a link in the description. We're going to go over what's happening in the global economy, including why Germany's behaving the way it is, why it's actually taking what seems to be a big step, and what it all means, what it means for interest rates, what it means for commodities, why are oil prices crashing, what about other commodities and other signals, what is the reaction to the dollar, and most of all, maybe what you can do about all of these global conditions and symptoms that we're seeing. So sign up for the webinar. Hope to see you Monday, March 24th, time to be determined. It might actually be a little bit earlier in the day because we do have a large audience outside the United States. So we're still working on what might be the most optimum time for everybody to participate, but it will be happening on Monday, March 24th. And there is a sign up link in the description of this video. Now, because this is a bazooka, because this seems to be a more than symbolic step for the German government actually trying to remove the debt brake restrictions, the bond market reaction has been fierce so far. Over the last couple days in particular, including today, the sell-off in bonds is continuing. The 2-year, the shots in Germany, that was down around 1.97% at the end of February, and it has since shot up to today, according to the Bundesbank, the central bank in Germany, their calculations. The 2-year rate is about 2.2%. So you're talking about a 23 basis point move. And remember, the ECB cut rates today and is likely to continue cutting rates. But German rates were already low, and that's a factor in this as well. German rates have been depressed for a long period of time. They were well underneath where the ECB was over the last couple of years because of the economic situation in Germany as well as the rest of Europe. So that's one factor in the sell-off too. German rates were already really low. The 5-year Bobl was down around 2.08% on February 28th. That's got up to 2.48. And the 10-year was 2.4% at the end of February, now 2.87%, and it's been into the 290s today, and it might continue going. At 2.87% for the 10s, that's the highest since October 2023, where it got to be 2.98%, didn't quite get to 3%, which was then the highest since July 2011. So the 10-year German bond, the rate there is already in sight of what would be a more than decade high. We're talking about going back, 13, 14 years now to July of 2011. So a huge move in the bond market in a couple days. So where's the sell-off coming from? And the answer there's a couple of reasons for it. One, this is just knee-jerk selling, same as we always see whenever someone goes to the bazooka. As I'll go over in a minute, we've seen this bazooka reaction in bond markets many, many times before. The short run is always dominated by selling safety. Fundamentally, you can look at it as higher growth and inflation expectations, at least over the longer run, and that's why rates are up more at the back end than the front end. That's the steepening in the yield curve. And the reason for the knee-jerk selling of safety is because you never know. People in the marketplace, again, as I said, interest rates were already low to begin with, and maybe this one will work. Maybe this is categorically different, and therefore different is better. I mean, that's the thing that we keep running across in many places around the world. What has been going on the last several years hasn't worked. So at the very least, doing something categorically different at least gives you a chance to have perhaps different results. So the knee-jerk selling of safety, because maybe different must be better. Nothing that's happening up to this point has worked. So there's a higher degree of uncertainty whenever these bazooka or any other plans, and we see this with QEs as well as central bank interest rate policies that are dramatically changed. So the path of least resistance is to sell safety and then just sit back and see where it goes. And not only that, there are people who believe in this stuff anyway. We're all taught from college on up, and it's reinforced across all of the financial media, that government stimulus is actually stimulus, despite all the evidence to the contrary, despite our own experience and historical experience. So there's lots of people who believe in this stuff to begin with. So the path of least resistance for interest rates in the face of a major announcement, a potential major break like this, is for interest rates to rise. Sell the safety and see what happens, at least in the intermediate term. As I said, we just did this in the United States and elsewhere. We did it in the US just last fall. We had treasury rates that sold off right from the point where the Fed cut by 50 basis points. Again, that's consistent with historical patterns, but we saw this before. Rates backed up with the Fed and its initiating and inaugurating its rate cut program, as well as the election. The election, for many people, represented a clear difference from how things were being done beforehand. So again, the allure of, hey, something different must be better, sell safety and see where it goes, at least in the short run. Understanding the probabilities haven't really changed all that much for the long run. That's because these kinds of selling squeezes, they never last since the euphoria quickly dissipates. And much of this is about an announcement effect anyway. Like we saw in China, and I'll get to that in just a second. They throw around these massive numbers trying to spark a sentimental reaction. Everything sounds good when it's first announced, and that's the point. The point is to make a big announcement, throw around these big numbers, kind of a shock and awe, and hope that the marketplace, not just the financial marketplace, but the commercial marketplace, will respond favorably to the government throwing around the big numbers. That's the point of a bazooka. It isn't actually the spending. I mean, what the Germans are proposing, or what we know the Germans are proposing, is €500 billion or thereabouts, but spread out over 10 years. That's not exactly as overwhelming as it seems at first. So they throw out the big number and make it a big number. Everyone reacts to it in a way that actually leads to the economic circumstances that they're trying to create anyway. It's the sentimental announcement effect that economists and central bankers are always talking about and always trying to study in their academic research. This is exactly what the Chinese did last September. It's exactly what they did. They throw on these big numbers. They're talking about borrowing trillions upon trillions of yuan, central government bonds that would be used for various stimulus sources throughout the real economy, and then we keep it up for years after year after year. Same as what we're hearing in Germany. Some of it would be dedicated to infrastructure spending like the Germans. Some of it would be a bank recapitalization plan. Some of it would be to bail out local governments. Big numbers, big numbers, big numbers. Let's see what we can get the market to do. But like we saw in China, it didn't work. In fact, China's bazooka last year was among its biggest failures. It barely even registered in the bond market because of all the previous failures. And I'm not talking about past failures and distant past failures, just in the past couple years. If you looked at China as an example of bazooka failure, it goes back to reopening in November of 2022. There was actually a similar reaction in the Chinese bond market, which is interest rates have been going down long run in the Chinese bond market for a long time, but there was a positive reaction, and interest rates going higher is a positive reaction, higher growth and inflation expectations. So in November 2022, when it looked like reopening was going to happen, the end of zero COVID, China's 10-year bond rate went from 2.66% to 2.96%. That's actually similar in scale to what we're seeing now in the German bond market. For the Chinese bond market, the 10-year to back up by 30 basis points, that was a big sell-off. The 1-year, right at the front end of the government bond curve, that went from 1.71% all the way to 2.28% on nothing more than reopening. Something different must be better. In the short run, sell safety and see where it goes. Fast forward to 2023, the summer of 2023. Everybody forgets this, but the Chinese came out with their 31-point plan to remake China's economy after reopening predictably failed. The government finally responded and said, okay, reopening failed. Now we're going to take it seriously. This is going to be for 2023, what was their bazooka then. So in the summer of 2023, the 1-year rate went from 1.427% all the way to 2.47% by December. So from July to December, you've got a 100 basis point move in the front end of the Chinese bond curve. So it was supposed to be this game changer. Something different must be better. The 10-year bond had less of a reaction, but still it was pretty substantial. It went from 2.56% in August of 23 to 2.74 by October. So there was a big fiscal push in late 2023 in China, and initially the bond market reacted in the same way we're seeing in German bonds. And then the big bazooka last year, which was supposed to be this epic shock and awe campaign, barely registered in the Chinese bond market, either the front or the back, because by then you've seen the bazooka too many times. It doesn't matter how many big numbers you throw around. The Chinese bond market came to realize none of it works. Plus the big change that the Chinese banking system was was operating very differently in 2024. So by the time we get to the bazooka, the bond market was already used to bazookas and saying, this doesn't actually work. We were willing to see where things go in the previous episodes, but where they went was the same place anyway. So there was really not much reaction in the bond market anyway to last year's bazooka. But even so, there was a backup in yields. The 10-year went from 2.05%, which was a record low, to 2.21%. Not a huge swing, but at least there was a temporary backup in rates then as well. We saw this back in 2008 and 2009 in the shadow of the worst parts of the Great Not Recession. You go back to the bottom in interest rates in that time, it was December of 2008. The 10-year was at 2.08% when the Fed announced zero interest rate policy and QE, which the market initially took as, okay, again, we'll see what happens here. But it didn't go all that far until the middle of January. In the middle of January, the 10-year was still 2.23%. But then the incoming Obama administration, again, something different must be better, started talking about a massive bazooka-sized stimulus plan, which became the ARRA, or the American Reinvestment Recovery Act, which didn't really reinvest much, nor did it lead to recovery, which was passed in the House on January 28th of 2009 as something like an $800 billion fiscal spending program spread out over a couple years. And at the time, these were gargantuan numbers. So the 10-year, in addition to QE and ZIRP and this major fiscal push, this huge bazooka from the U.S. government and the Federal Reserve, the 10-year got up to 3.98% by June of 2009, even as everything was still melting down. Now, there was still the natural impulse toward recovery because the end of the Great Not Recession was actually in sight by then. But either way, it went from 2.08% in December and 2.23 in January 15th, all the way to 3.98% by June, before the market said, yeah, this isn't working either. And interest rates went sideways for the next couple of years before falling down in 2011. The market sells off, gives this stuff a chance, let's see where it goes, only to pick up later, realizing it doesn't work. And what economists are looking for is a positive multiplier. What they believe in, what Keynesian economists believe in, is that for every dollar or euro the government spends, it leads to more than $1 in economic activity. Because if the government spends money doing something, that's income from somewhere else, and that income gets spent, and that becomes income, and that income gets spent, and that becomes income, at least part of it does, and on we go. That's the theory, that's the idea, but it doesn't actually work. And there used to be a time in economic history and economics where people realized that. It wasn't until 2008, 2009 that this attitude shifted. But before then, the idea of a positive fiscal multiplier, especially one greater than one, was at the very least controversial. In a well-known paper that was published in 2000 by Columbia University's Robert Perotti, what he wrote was, quote, "We should honestly admit that at present, our area of ignorance, even on basic signs of fiscal multipliers, is too great. At a minimum, this should suggest using fiscal policy very sparingly." But then after the experience in 2008, 2009, we did get more evidence of bigger stimulus programs, which did not show the results that everyone was hoping for, what everyone was expecting and told to expect. You probably remember a study that came out in 2012 because of what it actually found. It actually made the stimulus bill and even the idea of stimulus itself into a punchline. There was a paper published by Daniel Wilson in August of 2012 in the American Economic Journal. This paper estimates the jobs multiplier of fiscal stimulus spending using the state-level allocations of federal stimulus funds from the American Recovery and Reinvestment Act of 2009. Because the level and timing of stimulus funds that a state receives was potentially endogenous, I exploit the fact that most of these funds were allocated according to exogenous formulary allocation factors, such as the number of federal highway miles in a state or its youth share of population. Cross-state results indicate that ARR spending in its first year yielded about 8 jobs per $1 million spent, or $125,000 per job. And you probably remember hearing that somewhere because it was one of those things that basically showed how pitifully underwhelming the results were. And the reason why they were pitifully underwhelming is because the amount of government spending doesn't actually matter to the economy. In that case, the multiplier certainly wasn't one, and there's an argument to be made that it wasn't even positive with such ridiculous results. And if you remember at the time, The jobs market wasn't recovering no matter how much shovel-ready projects the government was willing to fund. If the economy is structurally unsound, it doesn't matter what the government does or how big. That was Japan in the 90s and the 2000s. That was the US in the 2009 experience. That's China today. Bazookas might actually make it worse, thus the possibility of negative multipliers. And they make it worse in the most common sense ways. They're unproductive. And in this case of Germany, infrastructure and defense spending are two of the most unproductive ways to allocate resources in any economy. Saying nothing about any other merits, from a purely economic standpoint, you could hardly be more inefficient and unproductive. So for the long run, this is not going to lead to an economic recovery. Again, the entire purpose here is to throw around big numbers to make it seem like something big has changed and hope that the marketplace and the real economy does all the work for the government. But because this is Germany, and Germany's now talking about removing its constitutional debt brake, this sounds like a big deal. This is something categorically different from where we've been over the last couple years. Therefore, the reaction to it, the short-run reaction to it, is understandable. Sell safety, let's see where this goes, because maybe, you never know, this time it could possibly work. The level of uncertainty over the future path of interest rates and the real economy has gone up. But it hasn't gone up all that much. It's gone up in the short run, but after a little bit of time, like we see in China, like we saw in treasuries, at these various points where bazookas are introduced, cooler heads prevail. We get past the announcement shock and awe effect, and as it wears off, everyone comes to their senses. And what their senses tell them is that this isn't going to work. We see all the historical evidence. We've seen how it hasn't worked in recent experience. We just look at China for the example of how bazookas fail. And after the initial, let's see how it goes, we go back to growth and inflation expectations that are more realistic. So we got the knee-jerk reaction in the bond market that is spilling over in other places simply because it's Germany. It's shock and awe. It's another bazooka. And this is what happens in the short run when there are bazookas. But the reason we see so many bazookas, ultimately what matters, and none of this works. We've got all this going on in interest rates. Talked about yesterday what's happening in commodities, in particular oil and gasoline in the United States. That's the video link below. As always, thank you very much for joining me. Check out Eurodollar University's webinar, March 24th. There's a link in the description. Huge thank you to Eurodollar University members and subscribers. And until next time, take care.